Welcome back. You're still tuned into Trading Hour, and let's focus on the market now, which, by the way, is back in the red a little bit after moving into the green. So we're currently around 40 points in the red. The mid-cap index is what is, holding up well. It is around 0.3% higher, and the Nifty Bank is also seeing a gain of around 0.4%. But let's talk about Piramal Pharma now, and we have a guest joining us who can take us through that conversation. Neil Bahal, founder and CEO at Negen Capital PMS, joins us on the show now. Neil, good morning and thanks a lot for joining us. This is Pavitra. So, let me just come directly to Piramal Pharma. We saw the demerger, we saw the listing. Take us through how you're looking at this stock now, after it being removed from the MSCI. How do you think the stock is likely to fare now? Because once again, it is doing well in trade.
Hi, Pavitra. Good morning. Just a disclaimer before I say anything that we own Piramal Pharma in our PMS. So this is not investment advice. It's just, I'll just tell you what has happened here. So Piramal just did a demerger, right, where they split their the NBFC and the pharma business. And whenever anybody used to buy Piramal, they would buy it largely for the pharma business because they have an excellent track record in pharma. They've been doing it since multiple years, and they have, they're very, very good at what they do. Now, what happened was they also had the real estate NBFC, and for certain years, the real estate cycle was negative. So whoever used to buy Piramal, they would largely take a call on the pharma business. But while valuing the pharma business, they also had to value the NBFC. So for whatever reason, the pharma business used to trade at a good discount to the peer group, let's say Syngene or DVs and so on. So it was already at a discount and it went for a demerger. So suddenly at a demerger, what happened was that the pharma business, the market capitalization reduced. And when it listed on its own, the market cap was lesser. So MSCI came and said, okay, you don't qualify to remain in our index anymore. And we got to delete you. So because of that, even more forced selling came from these passive funds. And the stock listed at 200. And now it's fallen down to 157 at the bottom. And I feel at this point of time, it's trading at a significant discount to the entire peer group. If you consider even something like a Suven Pharma, which is having a very, it's not at all comparable to Piramal in terms of how big the Piramal business is. Suven trades at a premium to Piramal. So I think in terms of what the MSCI has done, it's made this stock a little bit too cheap.
That point is taken, but that's in the past, right, Neil? I think the big question now is Piramal Pharma has a very differentiated business model, right? It's present in this whole CDMO space, contract development and manufacturing. 60% of its sales comes from there. What kind of growth do you see for this business particularly? And even in the other verticals, I mean, it has 30% sales from the complex hospital generics, 11% from India consumer products. So what is the growth and what's the fair value for the stock from here on?
Hi, Sonia. So what happens is that it's a very highly integrated CDMO business. So 60, as you rightly said, 60% of the revenue comes from CDMO. And this is very, very integrated business. I think in India, this is the only properly integrated CDMO business. Even if you take Syngene, they don't have the manufacturing capability even now. They're going to have that in FY24, where Syngene also will become an integrated player. So Piramal is a big company. I think they have 125 plus integrated projects that they're working on. So I think this company for growth there'll be nothing fancy in terms of growth, 15% growth, which is very good for a company this size and operating in a very complex market. The growth will be 15% on the revenue, but as the management has guided, there will be a growth, there will be a jump in the margin every year for the next, let's say, 2 years, 3 years, 4 years, 5 years. So while the revenue may grow 15%, something like an EBITDA over here may grow at 25%, in our opinion.
Neil, do stay on. We need to get into a quick commercial break. We'll come back and continue this conversation.